All right, let's dive into Amicus Therapeutics, ticker symbol FOLD. They just dropped their Q2 2025 earnings, and it was a really interesting day. The numbers look strong, the stock popped in the pre-market, and then it completely reversed and closed in the red. So what on earth happened? Let's figure it out. This right here is the big puzzle we need to solve. I mean, you get a solid revenue beat, and you have management standing by their full-year guidance. Those are two things the market usually eats up. And yet, after that initial excitement, the stock just faded. We're going to unpack that disconnect piece by piece.
Okay, so here are the headline numbers. Revenue came in hot at $154.7 million. That's a really solid beat of about $8 million over what the analysts were expecting and a 22% jump from last year. Nice. But, and there's always a but, if you look at the bottom line, their adjusted earnings per share was just a penny, which was a penny shy of consensus. So you have this classic story. Great on the top line, a little soft on the bottom line. And that combo often leaves the market feeling, well, a little confused.
So let's see where all that money is coming from. The big workhorse, as you can see, is still Galafold, their drug for Fabry disease. That brought in almost $129 million. But honestly, the real story, the part that has everyone's attention, is that smaller slice of the pie, the Pompe franchise. It might not be the biggest piece right now, but that is the growth engine.
And when I say growth engine, I mean it. The Pompe franchise grew an incredible 58% year over year. Management was practically beaming on the call, saying it was their strongest quarter for demand since they launched. This is the hypergrowth story that investors are betting on.
Now, of course, that kind of growth isn't free. You look at the operating expenses and you see they're up. But here's the crucial detail you have to catch. That number includes a $30 million upfront payment to license a new drug, DMX-200. The key takeaway here is this wasn't just runaway spending. This was a deliberate, strategic investment in their future pipeline.
And that brings us to management's story. CEO Bradley Campbell made sure to hammer this point home on the call. 17 straight quarters of double-digit growth. They're trying to send a clear message. This isn't a fluke. This is a durable, predictable machine, and they're building confidence that they can keep executing.
So how are they going to keep it going? Well, they've laid out a super simple three-pillar strategy for everyone to follow. You've got Galafold, that's the steady foundation. The Pompe franchise is the accelerator, that's where the explosive growth is. And this new drug, DMX-200, well, that's the big bet on the future, taking them beyond their core diseases.
And here's the real kicker. Even after spending that $30 million on a new drug, management didn't back down from their 2025 promises. They're still guiding for 15 to 22% total revenue growth. And most importantly, they are sticking to their goal of hitting actual, real GAAP profitability in the second half of this year. For a biotech company, that is a massive milestone. So, back to our big question. Why the fade? It feels like the market has two completely different opinions right now. The bull case is obvious, right? We just went through it. Consistent growth, strong guidance, a clear path to making money. But the bear case, it has almost nothing to do with this quarter. It's about the bigger picture. The whole biotech sector is weak. This stock in particular has been a terrible performer, and you just have that classic sell the news mentality kicking in.
And this chart, wow, this really puts that bear case into perspective. Over the past year, Fold is down over 43%. That's just brutal. It has massively underperformed the biotech index, which itself hasn't even been doing that well. So you have to put yourself in the shoes of an investor who's been holding this for a year. That pre-market pop wasn't a sign to buy more. For many, it was the first good chance they've had in a long time to get out. But looking forward, there is a lot to watch for. The second half of this year is going to be absolutely critical. We need to see that Pompe launch continue to fire on all cylinders. We're looking for them to finish enrollment in that big DMX-200 trial by the end of the year, and of course, everyone is watching for them to hit that all-important profitability target. Hitting these milestones could totally change the story for this stock. So, putting it all together, our final takeaway for the next call is a market perform rating. Look, the company is executing really well, and the strategy makes sense, but the stock is fighting a huge uphill battle against bad sentiment and a weak sector. They absolutely have to deliver on these upcoming catalysts to win back Wall Street's trust. And just so we're all on the same page, what market perform really means is we expect the stock to basically track its peer group, like that XBI index. It's not a buy, it's not a sell, it's a wait and see. It suggests the risks and the rewards are pretty balanced right here, at least until one of those big catalysts hits and makes us reevaluate everything.
Now, for a potential way to play this, with such conflicting signals, this stock is a perfect setup for a volatility trade.
One idea could be something like selling cash-secured puts. Basically, you're getting paid a premium today to agree to buy the stock later, but only if it drops to a price you already like, say $5.50 or $5. If the stock falls, great, you get to own a solid company at a discount you wanted anyway. If it doesn't fall, well, you just keep the cash you were paid up front. It's a way to get paid for being patient.
And of course, this is not financial advice.